Good afternoon. This is Serge Tedeschi with TradeJolt.com, and I want to show you a little trade I'm putting off after an earnings report. So Twitter, let me start by mentioning to you that the trades that we are doing here are risky trades, so I want you to be aware of my disclaimer shown here, that options trading, read this very carefully, is something in which you could lose all of your money, all of your bet, and sometimes you can lose more than the amount that you actually are committing to a trade. So be aware of what you're doing, and only undertake this with a portfolio that you can afford to lose in its entirety. All right, that said, I will show you the trade at hand. I wasn't following Twitter, but I did notice that it had a huge and positive earnings report. It had been going down and down and down and down ever since it first went public. And as you can see here, because of basically an inability to make money out of their traffic. They hadn't really figured out a way of translating all those eyeballs into dollars, and the market was punishing them for that. Basically, on the earnings report, we had less bad news, a large increase in visitor count, and an increase in advertising revenues that was surpassed what people expected, and the prognosis is for that to continue. As a result, the stock jumped from its level down here up significantly within a day. On the weekly chart, it looks like nothing, but on the daily chart, you see that is quite a significant rise. Also important is that it breached its former resistance level here at 2075. And the next resistance level really is here at $25. There's a lot of resistance. So probably it will, over the next weeks and months, reach this resistance level. I like to trace an RSI over, a 30-period RSI, and make sure that this level here, see where it meets, where it gets to the last, a similar level, and that's all the way up here at a price of $37. Again, that's not a perfect indication, but it's uncannily true very often. So I'm bullish temporarily on Twitter, and I wanted a little short-term scalp after the trade. So I mapped out, and the time I did it was around 1 o'clock, and Twitter had already made this move up and was just getting past this. You can't see it on the hourly candle. Let me go to a 15-minute candle. Okay, it was just here. It had dropped down here, found support, and made it to a higher high. Usually when it's able to breach that higher high, it has another leg up. And that's where I figured it was going to reach. What I did was to simply extend a Fibonacci from one second. I'll show you what I'm trying to do here. If you consider this a wave with here the little curve, then it's likely to replicate that wave, and that would take it from here to this point. That's the replication of that wave in Fibonacci terms. So I expected a minimum rise, a minimum rise to this level, and a probable rise even higher than that. Seeing this as the first wave, this as a second wave, and a third wave that would carry us higher. Basically, that was the reasoning for my trade, And here is the trade, and I wanted one that had an asynchronous risk. In other words, if I was wrong, I would lose a lot less money than if I was right. If you figure throwing darts at a board, you're going to be right. You're going to be right actually only 1 out of 3 times. Because with options, you lose money if the security in question doesn't move, unless you're selling options. But we're not selling options here, we're buying options. So so you're only going to be right 1 out of 3 times, so you better make sure that your risk reward is better than 1 to 3. That's how I see it. And if you can do that, you'll make money with options. So here is the risk reward that I drew. As you see, what I risk here is roughly $109. That's the cost of putting on this position. And the reward is a possible $1,000 roughly dollars. So it's about a 5 to 1 risk reward relationship. So now let's I also want to mention something else that I've learned the hard way. Don't trust these graphs. If you're using any software, don't trust it. Challenge it, question it, because otherwise you'll be taken to the cleaners more than one time. This particular software, OptionView, is about the best I've seen on the marketplace, but it still has its little quirks and, yes, defects that sometimes creep up. And unless you challenge what you're seeing, you can make a bet based on the graphics and lose your shirt. So again, knowledge is important here. In this particular case, what I did was the positions I was putting on, let me see if I can get them all on the screen here. Let's see, 22 call and a 23 call. Okay, so let me move up. Looks like I'm going to need to get rid of my legend. There we go. And now hopefully, there's my 23 call. Okay, so basically, I agreed that somebody could buy it off me at $23. Now that has unlimited risk, because in theory, the stock can go to the moon. If it goes to $50, I still have to sell it to somebody at $23. And for those of you who think it'll never jump like that without you having time to react, remember buyouts. Company buyouts from one company to another can happen overnight, and a stock can jump up overnight by 25, 35, 40% at times. So you can and will get taken out if you think you'll always have time to react. So what I did here to cover my risk, I was exposed here all the way till November 17th. That's when my obligation ran out. And I get to collect the whatever amount of money, in this case 5 cents per share that I'd collected. So I covered it with a bet which gave me the right to buy it off someone at $22. So if I was forced to sell to somebody at 23, I could buy it at 22 anytime I wanted, and that would basically be worth $1 intrinsically. Buying for 22, selling for 23. Buying that, I was covered for a longer period of time. This one is valid for, 3 weeks from today, whereas this one was only valid for 2 weeks from today. So if you look at that, logically, there is no way of losing more than what you are out of pocket, which you see here is $113. You cannot lose more than $113. And if you think through all the scenarios, you'll see that you cannot. So basically, that's where, don't rely on the graph. Double check the numbers in your head on paper. And if you can't do that, maybe you shouldn't be putting on the position. Okay, so this was my risk reward yesterday. This one happened to go with me in the direction I wanted. So let's fast forward to today. Okay, it is 3:15 in the afternoon the following day, and the stock has moved up here to 21.86 and actually shows no sign of moving down yet. So it's looking quite good. When I look at the well, I've already taken a position, so let me a corrective move here, which I want to show you. So let me go back in history, but just by an hour or so. So we're going to go to the 27th, but we're going to go back, excuse me, that's forward. I'm going to go back to 2 o'clock, and I had not yet placed my trade. So this was what I was looking at. I had, as you can see here on the dot, I was going to make, I had already, if we go to T+0 here, 1 second, we were making about $180 here. And it looked good since the stock looked like it's going to move higher. However, while I like this, what if something were to happen over the weekend that I can't foresee, and it sends all stocks, including Twitter, down lower? So I would lose all the profit that I've made here. And I thought maybe there's a way of locking in the profits, but still allowing me to make more gains. And in fact, there is. So what I did is I took my profits here, which were now, I'd paid 13 for this and they were worth 53 cents. So I took my profits here and entered a closing trade to take my profits. And then here I went long because otherwise I would have exposure with 12 contracts here. So I need to cover that exposure, but I cover it at the same price. So I will not make money when I sell it. Okay? If I'm forced to sell it, I can just buy it back at exactly the same price. Now, the reason for that is this will lose money at a slower pace than this one, will decline in value at a slower pace. So this will erode all of its value by November 17th, but this will still have residual value. That's the logic behind that. And if we then, so I did that trade, which takes me to today's position. Oh, let me also show you the trade. So here in my trade log, I sold my 22 call for 81 cents, which I had originally bought for 13 cents. So I locked in a $68 profit per contract. That's done, it's made. Now let's look at where I am going forward. Well, here's where I am. As you can see, it doesn't matter how far out I go, okay? As far as the heart can see, I have locked in that profit. I cannot lose that money anymore. But look what happens if the stock keeps on moving up. I can continue to make, and now I'm not going to be in any hurry to sell. I will wait until the 22nd day because this transaction gains value over time. As you can see, it has positive vega, meaning every day it gains $15 in value. So I can be very patient. I can be patient 22 days. The more I'm patient, the higher this price will go. So now if it were to rise quickly to 23 in say 6 days, I might want to do something a little bit different, maybe take my profits, because from then it's going to gradually go down. But that were only if I was sure that it were going to keep moving up and wouldn't maybe fluctuate here and end up in this region or close to this region, price region, around my expiration. So basically, with this trade, I have a guaranteed gain no matter what happens to the stock going forward. So I risked, if you recall, $108, and I'm guaranteed a minimum return of $240 on the trade, and possibly as much as $840. That's it. I thank you for listening, and keep posted for more trades on TradeJolt.com.